Niren Shah, Managing Director with Northwest Venture Partners. Mr. Shah, good morning. Thank you for joining us.
Thank you for having me.
Time to shop or time to conserve?
Time to shop.
Why is that?
Well, we look through everything. So I would say that our horizon is 3 to 5 years. So if some of the viewers here have a 3 to 5 year horizon, I think the doom and gloom may last a couple of quarters. But eventually, this is the only country, it's the fastest growing country in the world. You have to look through some of these. These are great opportune times to start buying. And that's exactly what we're doing as a fund. As Norwest, we are sort of, looking at investing at a pace, which is double of what we were doing earlier. So our view is very simple that when you look at sort of a 3 to 5 year horizon, and if you can come in at these kind of asset prices, there's only one way, which is up. And I think the country will do really well.
But shop where, given that there's a sale at many places?
Yes. So I think look for great management teams. I think that is, look for companies which, have been hurt by this cycle, which have withstood the test of time, but have had issues maybe at the tip of the cycle, which have cracked and which are actually providing good opportunity. But the big difference here is that you have to look through this cycle, right? You have to look through 9 months or 12 months and then sort of take a 3-year view. I think a lot of your viewers will get a 2x in 3 years quite easily, but a lot of them are just looking at the next quarter.
Okay. You also mentioned that the firm will strike a balance between investing in growth equity and the venture space.
Yes.
So share with us what the strategy really is.
So our strategies, look, we are a 10-year fund. We look at basically investing in growth equity where we do $10 to $40 million checks in unlisted companies. And those are profitable and something we can take IPO. Okay. So though we've taken about 5 or 6 companies IPO and we expect to take another 5 in the next 2-3 years. And then we sort of juice those returns with venture capital where we're very early investors in companies like Swiggy and Pepperfry and Quicker. Yatra, a few others where you can make a much higher IRR and cash on cash, but you hold that for longer, right? So
let's address all the businesses which you invested in.
Sure.
The travel space.
Yes.
There is a problem there.
Yes.
Cox and Kings has gone belly up.
Right.
Others are struggling. Thomas Cook globally has gone, belly up.
Right.
We all are traveling more.
Right.
At least we all on this table can confidently say we are traveling more.
Yes.
But none of the travel companies are actually making money. The websites are losing money.
Yes.
Make My Trip has not really had a good earnings quarter.
Yes.
And back home also, like I said, Cox and Kings has gone belly up. What is happening there?
So travel has been one of the first sectors to go onto the net, right? Yeah. So if you see the guys who are doing really badly, the Cox and Kings, etc., they are more offline. And I think more and more is going online. But because online is such a big space, you're seeing that the competitive intensity of the online space has hurt earnings for some of the companies. But eventually, if you look at China and US, people don't go to their travel agent, unfortunately. They go online and they book it themselves, even packages, things like that. So it is a large sector and I think it will continue to do well. But there is some temporary competitive pressures which are hurting some of the companies' earnings. And the offline space will increasingly become more online or omni-channel.
What about a space like Pepperfry? It's been in the market for a while now, for as long as one can remember, for the last 10 years or more maybe. It has that brand recall at least. Right. But at a time when the industry is facing a slowdown, we know what's happening with the housing market. How do businesses like Pepperfry really sustain?
And before you answer that, IKEA.
Right.
You can shop online in IKEA.
Absolutely.
Yes. My wife loves IKEA.
Right. Great question. So firstly, Pepperfry has been around 7-8 years. It has a great brand. We're an investor. We're the largest investor in there. So what we're noticing is that sort of furniture has come of age. So one of the big things is we're not really fighting or competing against other players, whether it's IKEA or otherwise. You're competing against the carpenter. If you go to the US, nobody calls the carpenter into their house to do up their house. It's all ready-made, right? And that's happening. You're starting to see that J-curve. So Pepperfry is actually reducing their cash losses every month and growing at 50% while cutting burn and increasing margins. So this is a company we hope like in 2 years from now, probably someone is sitting here saying we just went IPO. But these are the kind of companies we see from the consumer tech stable, which should go IPO in the market in the next 2 years.
No, but my question was that isn't a business like Pepperfry also facing the heat because the sector is also slowing down?
It's not actually, because what's happening is the main only 3% is online. And what we're seeing is a lot of folks are moving online to buy. So like I said, these guys are cutting their burn. Right, so they're increasing margins and still going 50%.
So they're not purchasing homes, but they're redoing their homes, is what you're saying.
Yes, people are doing that.
I want to talk about IPO, and one that may get there way quicker is 5-star.
Right.
And you've got a lot in the financial space actually.
Yes,
talk to us about whether or not you see any of these companies actually becoming, as I think you've mentioned earlier, the Alibaba of China here in India. Which one has that opportunity to scale? Is Five-Star one that you're looking at, for example, to IPO in 2 years, which is a much shorter runtime than the likes of a Pepperfry?
So I think Five-Star will also IPO within 2 years. I think it's already doing really well. It's its profitability is in excess of 200 crores right now. I think we see that company. It's already become a unicorn from a venture funded company. So we see that company really going places. And I think that it could be 2 years. It could be a little shorter than that, but you'll definitely see that company go IPO.
So the other interesting thing to me is that for a firm that's actually been a little slow and steady or careful before investing, today you're sounding so bullish, right, over the next couple of years.
Right.
And this is a time when other people started talking about whether or not this is a bubble.
Right.
You're sure that this isn't a bubble scenario that we're going to see in the next couple of years?
So I'll tell you what we're focused on. By the way, we've always been bullish, but we've always been deliberate, right, and thoughtful. So I think even when there were cycles and bubbles, we've sort of invested through them.
Okay.
Right now on the VC side, I do see a bubble, but we are investing through that. We're looking for companies which will 5 years later still be great companies. On the PE side, we see that the great companies with great founders will do well. They're highly profitable, and it's a matter of time, regardless of the rest of the market. It's just a matter of time before they start going IPO. And so again, Five-Star Finance or SK Finance, some of those companies, very robust, highly profitable companies. It's a matter of time as to when we want to take them IPO.
I always like to use this phrase, which is that go for two things, which is buy a small cap which could become large cap.
Right.
If you missed on that, doesn't matter. Buy good companies which could become great companies.
Yes.
So let's classify that. Which are the small cap businesses, according to you, which have potential to become large caps?
Right.
And which are the good businesses which you own have potential to become great companies?
Right. So, I mean, look, we, like I mentioned, we have these couple of small caps in the financial space. We have this company called Off Business. It's a fintech company. It's actually doing 4 crores of profit PBT every month. Very rare for a fintech company in the consumer tech. They all lose money, actually. They all lose money. Great founder. We have another company called Veritas Finance. Again, very small cap, very good business. But I think that these will grow. Again, they are probably 3-4 years away from IPO, but they are growing very rapidly. But at the same time, the absolute NPS, forget percentages, are remaining stable or going down. So they're such good sort of strong companies, and we track all these companies for 3-4 years before we actually make an investment. The other one we really like, for instance, is maybe a little bit large cap, is Swiggy. Swiggy, for instance, effectively employs 2 lakh people today. Will go to 5 lakhs in 18 months, growing really quickly. In spaces like food, but also in groceries.
When are they going to turn profitable, though?
I think it will be like the core business, probably the matter of about 18 months. Okay. And now they're doing a lot in the grocery side, and those businesses obviously will require some more investment.
And they're charging per delivery as well.
They charge per delivery. No, and I think that they're making sure that the consumer gets what they want, and sort of the darlings of the consumers. Everybody raves about them, but at the same time, they're making sure that this is a financially oriented business as well.
True. Since you've got your ear close to the ground, and I'm sure even if you don't invest, you meet a lot of these budding entrepreneurs, millennials, what have you. Where is the big disruption? Like you said, the disruption happened 10 years back when travel moved online.
Right.
Is there any such trend that you foresee happening in the next 2 to 3 years?
Yes, we are in the middle of a major disruption.
Which is?
I think internet and tech. Right. What we're seeing is there's about $45 billion of GMV in 2018. That should go to 500 billion. The $100 billion of market cap should go to at least $1 trillion. This is the same 8 years which China went through, where it went from 50 billion to 2 trillion. Of course, our GDP per capita is much lower, right? But even then, we're actually seeing that US has 300 million internet users. We're already at 560. Right, so we surpassed US in number of users, not purchasing power, in 2015 itself.
That's because we're larger in number.
We're very large, and it's a very large market. And in this market, so therefore, I think that the next 8-10 years, you will see a very large sort of internet tech ecosystem develop. We're already seeing that, but this is going to multiply 10x.
Is it a good time? Is it a good idea to compare India with China? We always compare that, but let me give you some examples which I used to hear 10 years ago.
Right.
China is selling X number of cars, India is selling Y.
Right.
It will catch up.
Right.
China's per capita is X, India's per capita is small x, it will catch up.
Right.
China's GDP is X, India's GDP is small x, it will catch up.
Right.
10 years from now, our per capita is struggling to cross $2,000.
Yes.
Our car sales have plateaued down.
Right.
Our GDP, because of whatever factors, is just nowhere close to what China has achieved in the last 5 years. So China is the big picture.
Right.
But that canvas is a different campus.
I agree. So could not agree more. In fact, that's the part of our deliberate and thoughtful strategy that we have not bought into that. But what we do buy into is we have the volume, right? And what we're saying is that our GDP per capita may be 1/3. So let's not assume we will create $3 trillion of internet market cap like China has, but let's assume we might create 700 billion to $1 trillion, which is 1/3 the size, not equal to China over an 8-year or 10-year period, right? So I actually feel that there is a huge opportunity over here, but at the same time, it has to be more mass market. Companies where like Pepperfry or Swiggy or Quicker are playing, because that is the market which is really growing.
You know, I'll tell you what, it's the first time we've interacted with you, so I just want to give you a flavor of our Diwali programming.
Sure.
This time is Rakesh Junwala and Kareena Kapoor Khan.
Wow.
And it's a very interesting conversation they have about where her
Everything
career,
under the sun.
Everything under the sun. So I just
What
want you to see that
markets?
excerpt, and then maybe you can watch the entire show over the weekend.
Sure.
Let's play out on part of that chunk.
How do you keep away Taimur? How do you give him time and keep away from the paparazzi? And what effect does that have on them?
Yeah, I mean, he is just Saif Ali Khan and Kareena Kapoor's son, but he's actually not a celebrity. I mean, I think the media has made him that, but Saif is like, who is he? He's nobody. He's just our son. He's like, I don't want to like cover my son's face and take them in front of the media. He was like, because that will scar him even further. Hi, this is Kareena Kapoor Khan, and watch me in conversation with Mr. Rakesh Jhunjhunwala only on ET Now.